Good morning, everyone. Welcome to this update for global stocks and commodities for the 29th of September. We've got more and more geopolitical risks coming up. US ratcheting up pressure on China. And of course, we've got the crazy situation in the UK with Brexit. And markets have remained pretty calm through the whole thing, I must say, surprisingly so. And I guess that really points to the fact that markets are driven so heavily these days by interest rates, and there is really no indication that interest rates are going to go up anytime soon. In fact, they're probably going to go lower. So that's the situation that we find ourselves in. In this update, I just want to try and paint a realistic picture around what all this geopolitical noise means, and it doesn't mean a great deal really for the market in the long term. It just causes volatility, which can be a bit upsetting to some people. And the other point that I want to make is that, and I know from reading various analysts and just things that I see around the place, that it's very important not to wait for an all clear signal to get back into the market. That just don't. It just doesn't sort of happen that way. So yeah, they're the things that I want to touch on this week. Portfolio Analyst. Last week, amongst many other good questions, I covered the lithium and uranium markets. Now, let's get on to American stocks. The S&P ended up falling 30 points, 1% across the week. The market was holding up, but trade remains very much the focus. And, we saw quite a few ups and downs with the trade negotiations over the last week or two. And despite all the uncertainty, the index is still at the levels that it was at May 1 this year, and it's just been basically fluctuating up and down in a fairly tight range. So a lot of people have been anticipating that all this noise out there would really upset the market, but it just hasn't happened. We've now got the impeachment of Donald Trump on the table as a possibility. And also the White House, if things weren't bad enough, the White House decided that now would be a good time to pursue this agenda about possibly delisting Chinese stocks that are listed in America. I mean, goodness me, they couldn't have picked a worse possible time to do that. So a couple of things that certainly weren't a positive for the market, but it didn't really impact it all that much. The US dollar was higher again. The 10-year yield eased back to 1.68%, down just a fraction. So let's jump in and take a look at the S&P. So you can see here's the level we were at on the 1st of May, and we're basically trading at that same level, and we've just been pivoting a couple of hundred points below and about 150 points above, and the market really just sort of going sideways and not really showing any indication. So we're still holding above the 50-day moving average. So from a technical point of view, this is still quite positive. The 50-day moving average is still rising, and so is the 200-day. You can see the 200 days just turned up again now, and the price is above both of them. So that's really all you need to know, that there's a positive orientation to the technical part of the S&P index, and it's really trading far more in line with interest rates than it is with corporate earnings in the short term, although there are projections for those to pick up next year, or all the geopolitical rubbish as well. Let's just look at the US dollar index. So pretty much in the upwards direction throughout the week is pretty much where the US dollar went, and it's still maintaining this upward trajectory that has been in place since the lows that we saw in March of 2018. So it's been pretty much straight up for about 18 months now. Moving on to Australian stocks, the Aussie dollar was unchanged. It's just above 67.5, and our index fell 15 points, which was very marginal for the week. And as I wrote last week, I think it's important in Australia if you want to get a good return and um, have a return that looks reasonably stable for the medium to longer term. The idea is to focus on businesses that don't require a lot of capital to grow and have some sort of network effect or some sort of really strong niche in place that's going to allow them to keep growing irrespective of what the macro picture is doing. And those stocks are out there, they do exist. Some of them are exceedingly overvalued. They're being priced for perfection in the future, which may or may not play out. But there are still others that are quite reasonably priced, that are somewhere between, PEs between 12 and 15, with growth rates well in excess of that. So there's still places to go in Australia where you can still get a good deal. And the final point I want to make on the Australian market, and I don't think this has given a lot of airplay, but it certainly became very apparent after the last reporting season, is that there's a lot of traditional bricks and mortar stocks, dividend stocks that people would normally go to when things get a bit nervous. If you want to lower your risk, or this is the perception, you want to lower your risk, then a lot of those stocks are actually at risk of having to cut their dividend. And if they have to cut their dividend, then the capital value is going to get whacked as well. So you're going to cop a double whammy. You're not going to get the dividend that you think you're going to get, and it is going to impact the capital value of the share. So you're going to have a reduction in capital value as well. So they're not the default option that many people assume they are. So, if you're looking for somewhere safe to hide because of all this geopolitical risk, then it is not necessarily in the standard Australian dividend payers. And I can't stress that point more highly. Let's take a quick look at the Australian index, to the ASX 200. So we were down on Wednesday and Thursday, and that sort of did the damage. We were unable to recover enough on Friday, and I would imagine that we'll open probably pretty flat on Monday morning. Looking at the US, looking at precious metals rather. There's the precious metals, gold on a daily chart. So we declined to the 50-day, but managed to scramble back above it. So it's also just holding in this sort of range here. And let's look on the weekly for a bigger view. And I've been speaking about this now for a few weeks. So what I'm expecting, this rally is at the stage where a more complex, more extended sideways consolidation would play out. So we went down, we've had a little bounce. So we had a bounce the week before. Let me just zero in on that a little closer. So you can see we declined from being probably fairly overbought. We had a rebound the week before, the one just gone. Last week brought us back down again, and I'm just still of the view that we're likely to get this sort of up and down, choppy, sideways movement, perhaps through towards the end of October. And then traditionally gold gets into a seasonally stronger period of the year. And, I just think that all sort of fits. Now, that's not a prediction or a guarantee of what will happen with gold, but that just fits with what the normal patterns would be. We're at the stage of the rally where a more extended consolidation is normal, and the seasonal patterns fit in with this quite nicely as well. Let's look at GDX, and it's tracing out a pretty similar pattern. So we're not really getting a lead from GDX, the gold stocks, that gold is either going to break up or break down. And often GDX will lead a change in direction, but we're not seeing that. It's really tracing out the same pattern. So from my perspective, so gold down, it was down $20 to $14.98, but GDX following the same pattern, which it further lends weight to me that we're going to see some consolidation for a bit longer in the precious metals market. Copper was steady at $2.60, and crude oil declined from around 58, and it's back down to 55.8. So how things have changed just in a couple of weeks. We were trading down around 53 before the Saudi bombings. The price shot up to about 62, 63, and you know, all that declined again very quickly back to where we were. There's the spot copper chart, so not much change there, and still tracking nickel as well. So nickel put on a really substantial gain on the back of what the Indonesian government is rumouring to do, and then has managed to hold that level around $8 a pound. So that's sort of feeding through to Australian nickel stocks, which are performing quite well. So to wrap it up, it's really important to keep the global situation in perspective. If you trade local Australian stocks, then a declining US market, if indeed that's what happens, and I'm not saying it will, but a declining US market is not automatically a showstopper. It's not something that necessarily leads you to do anything different in Australia. It depends very much on how it declines. If we get some mildish declines or fairly sporadic movement down, it's not really going to feed through into the sort of growth stocks in Australia that I think are the real good risk reward opportunities. So it's mostly about interest rates, and there's absolutely no indication that interest rates are going to start to go up. Inflation is just not appearing anywhere, which would be the only reason that interest rates would have to be put up. It's all feeds through fairly nicely because low rates are forcing investors and forcing fund managers into growth investments to get a decent return. And, that's just the long and the short of it. There's a lot of people in the Australian market, in the equities market, that don't really want to be there, but they're being forced to, to chase those growth returns. And that, of course, is creating really good momentum in those growth stocks. So that's it for this week. Portfolio Analyst, I'm just going to continue the theme of growth because to me, growth is the most important thing. If you're in a company that doesn't have the capacity to grow very much, and it may be carrying a fair amount of debt, then I think that's actually higher risk than some of these growth stocks in times of uncertainty. So I think growth is absolutely the place to be. You've just got to be judicious about how you go about it. There's my contact details for anyone who's not a member of any of my services, and I'll be back with you next week. Cheers.